Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we had completed till the banking awareness, banking history, banking evolution and the types of banks, right? These are the topics which we had covered so far. I hope that you have revised them well because it is very necessary for your examination, right? So in this lecture, we are going to start with another topic, or you can say another series of topics. Okay. And this is going to be a very interesting series because the topics we are going to cover in this particular series are similar to the topics we had completed already. All right. And basically, here are two things are going to be happen. The first is that you will get to know whether you have revised your lectures or previous lecture well, because when you see these topics, you have to connect these topics together, then only you'll be able to grasp the facts. Alright. Second thing which is going to be done is that you will be able to mapping the things. Alright. Because here are two types of topics, similar topics and the new topics. Alright. Similar topics could be done for the revision also, and the new topics could be done for the new learning. All right. That's why I have told you, if you have revised the previous lecture well, then only you will be able to map the topics properly. Okay. So with this note, let's start this lecture. And basically in this lecture, we are going to start with the banking reforms and mergers. Okay. We are going to start with banking reforms and mergers. All right. So let's start with the first topic, which is called as a banking reforms. All right. So basically, the first question which should come in our mind is that what do you mean by the reforms? What do you mean by it? So basically, we can say banking reforms refers to a series of measures and changes implemented by the government and the regulatory authorities to improve the efficiency, stability, and transparency of the banking system. Okay. Or we can say, actually, we had the banking in the three phases, as we had discussed in the previous lecture. Ancient India, thereafter we had a banking in the medieval India, thereafter we had the banking in the British India, all right, and now we had the banking in the independent India, right? So these are the four types of banking we have. All right. So can you tell me, from ancient to medieval or medieval to the British and British to the independent India, are the banking structure, the banking practices, you can say the banking theories same or not? No. These things have been evolved over the time. All right. Because there is a completely change in the need of the time. All right. That's why we required a reforms. Okay. So reforms is basically the measures, or you can say the changes which we generally done in the already existed thing. Okay. These are called the reforms. Suppose in your school or college, if you are asked to come at 9:30 a.m. Okay. But during the certain period of time, it was found that most of the people are not able to come on 9:30 a.m. All right. Because of this, there is a shortage of attendance. All right. And the people who are coming late are basically getting frustrated because they have to face some penalties imposed by the organization. And when the organization finds it out that because of the distance, the people are not coming at 9:30 a.m. So they required a reform. And what should be reform? They said, okay, instead of coming at 9:30, you can come at 10:30 a.m. All right. So most of the people who were coming late due to the distance are now able to reach on the time. Okay. So the timing is already existed. We had just changed it and we had just taken the measure. All right. This is the reform. like the practices, like the scenarios were already existed in the market. But due to the some problems which we finds out time to time, or due to the some needs which we face time to time, we have to change the system. And this change or the measures which we had taken so far are known as the reforms. Got it? All right. So this is the meaning of reform, because to improve the efficiency, the stability and the transparency of the banking system. Reforms are aimed at promoting the financial inclusion, enhancing credit availability, strengthening the regulatory framework and addressing challenges faced by the banking sector. So these are the key, you can say, objectives behind the reform. Like when we find out that we need a financial inclusion, we made some changes. We find out that we have to enhance the credit ability, we have make some changes. We finds out that we have to strengthen the regulatory framework, we make some changes. And we find out that there is a various challenges facing by the banking sector in the economy, we have introduced some changes. Okay, so these are the some of the major grounds on which we require the reforms. Got it? So the first reform which we have done is the nationalization of bank. In 1969, there was a first nationalization. And when was the second nationalization happen? Come on, I have told you already, and it is a question also from my side to you. You have 10 seconds to answer and your time starts now. It's 1, it's 2, it's 3, it's 4, it's 5, it's 6, it's 7, it's 8, it's 9, it's 10. So the second reform was actually happened in the year of 1980. Okay, so in the first reform, how many banks were get nationalized? 14 banks were get nationalized. In 1980 reforms, how many banks were get nationalized? How many banks? Again, 10 seconds I'm giving you. It's 1, it's 2, it's 3, it's 4, 5, it's 6, it's 7, it's 8, it's 9, it's 10. Total 6 more banks got nationalized. Alright, so remember, nationalization of bank in India taken 2 places, or you can say taken places for 2 times. Okay, first in the 1969 when the amount was 14 banks. Second in the 1980 when the amounts were 6 banks. Got it? Now, what was the role or what was the reason behind nationalization of bank? Okay, so in the Indian 1969, the Indian government nationalized the 14 major banks, bringing them under public ownership. This was done to achieve social and economic objectives, including extending banking services to the rural and urban areas. Okay, so basically, if we diversified the objectives behind the nationalization of the 1969 as well as the 1980. So basically, there are 2 main reasons. Okay, first is the poor population. Second is the area more in semi-urban and rural areas. So these are the 2 main challenges on the time of the independence or after it. Alright, the first is the poor population. Okay, I have told you many times, and even I had granted you the examples many times, that whenever we have a bank like ABC, okay, and if this bank is a private bank, so the private organization have only one motive, which is the profit, and bank's profit comes out from interest at loan minus interest at deposit. Okay, what the interest they are getting on the loan and what's the interest they are providing on the deposits, this states their profit. Okay, for example, 8% they are getting on loan, 4% they are providing on deposit. It means total 4% will be their profit. right? That was the thing we had discussed. Okay, so if the ABC is a private bank, so they will always try to focus on the profit section. All right, they will not granted the loan to the poor population who are not able to afford the loan on the higher interest rate. Okay, and why the ABC will try to give the loan on the higher interest rate? Because the ABC have the limited resources and they will try to optimize it at the fullest level. It means they are trying to give it to the businesses or industrialists. All right, but the poor population which also required a credit need will be ignored by them or will be unattended by them. Okay, that was the first reason why the government has acquired the 14 banks. It means that when the government will have the control of these banks, the government prime motive will be public welfare, not the profit. All right, so that if the bank ABC will work under the government, then the government can direct it to grant the loan to the poor population. All right, second reason was the area more in the suburban, semi-urban and the rural areas. When the India got independence and after to the 60 to 40 years or 40 to 60 years, you can say, okay, Indian economy was suffering from various challenges. And the one challenge is slow growth of urbanization. Okay, urbanization refers to the secondary activities and the tertiary activities, which were very limited on that time. All right, due to this, majorly area comes under the rural or the primary sector, and the credit ability in the rural and the private sector was very poor. Why? Because again the banks were focusing on the urban areas so that they could get the customers who could afford the loan on the high interest rate. So these why the government, after acquiring the ABC, can also direct the bank to grant the loan to the semi-urban on the rural areas. So these are the two main reasons why the acquisition should be done. Okay, I hope that the point is clear to you. Now, next. The nationalization aimed to reduce the concentration of wealth and promote the financial inclusion by ensuring that the banking services were accessible to the wider segment of people. Okay, on that time, the wider segment was poor and the narrow segment was rich. Okay, and the banks were only focusing on whom? On the richer section, because they are able to hold the loan for a high interest rate. All right, that's why. Second is the concentration of wealth. Okay, suppose if the bank is only granted the loan to the industrialist or to the businessman, all right, and the poor people or a small trader who wants to grow himself is not getting enough credit limit from the banks so that he could grow it. Okay, so for this also the government nationalized the bank so that the bank could entertain both in a equal way. All right, second point, and the second you can say the reform was the liberalization. All right, liberalization was happened in the year of 1991. Okay, and what was the name of the policy? What was the name of the policy? The name of the policy was New Economic Policy, right? And the reforms were known as liberalization. Second one was privatization, and third one was globalization, right? So the liberalization was also one of the most important provision. Okay, in the early 1990s, India initiated economic reforms to liberalize various sectors, including the banking. This period marked a significant shift in the banking sector as it allowed private and the foreign banks to operate in India. Okay, so you can say after 1947 till 1991. So you can say from the time of independence till the new economic policy, Basically, in India, there were so many restrictions on the banking sectors as well. The first is that the private banks were not allowed to operate in India. Okay, as we have seen in the 1969, the private banks had to be converted into the public banks. Similar thing was happened in the 1980. All right. Second was the foreign banks. Foreign banks were generally not allowed to operate in the Indian market. Okay, so these were the restrictions, and due to this, the public banks were under pressure. Why? Because they are limited in number and they have to deal with the larger segment of population. Okay, and due to this, the economy was also suffering because the banks which were especially designed to help the economy were facing the challenges even in the operations. So how they could help the economy, right? That's why in the 1991, when the new economic policy was introduced, the liberalization was the step. It means the private and the foreign banks too are allowed to operate in India, so that the peer pressure on the public banks could be downgrade, and even the public have more and more access to the banking sector. All right. Banking sector liberalization increased the competition. It means increase the competition means that the banks were also focusing on improving their services for the customers. Okay, modernize banking practices and improve the quality and variety of financial services available to the customer. Because when the customer got some more option, so you can say, suppose this is the customer we have. Prior to the 1991, he has only two options, A and B. Whether to go A, whether to go B. This is a limited combination. After the economic reforms, now he has how many options? Various options, you can say. Okay, so it means that he is no longer need to be worried about for which bank he need to choose. Now the bank has to be worried about that whom bank should he choose. Okay, that's why the bank will try to convince him to come themselves. Okay, that's why the quality and the variety of the financial services were increased. Okay, thereafter the priority sector lending, we had already discussed in detail about the previous lectures. Okay, and as I had promised you that we have a separate lecture on this, in which we will discuss the technical terms related with the PSL. All right. Reserve Bank of India mandates that the banks allocate a certain percentage of their lending to the priority sectors, including agricultural, small-scale industries, and the weaker section of society. As we had discussed already, let me remind you the example. If the bank has 100 crore rupees as a reserve, as a reserve, hundred crores as a reserve. Okay, so can the bank lend out entire 100 crores amount to the loan people? No, they have to deduct some changes. First is the CRR, second is the SLR. Okay, suppose the CRR is 10%. All right, it means that rupees 10 crores. Okay, so when the 10 crores were minus from 100 crores, then the remaining amount will be 90 crores. Okay, SLR is suppose also the 10%. It means 9 crores. Okay, 10% is the 9 crores. Okay, so 90 crores now minus 9 crores, remaining will be 81 crores. Okay, so after deducting the CRR and the SLR from 100 crores, then 81 crores will be left with the bank to grant as a loan. Okay, still there comes the condition known as the PSL. Okay, so the RBI will ask the bank called XYZ that okay, you have rupees 81 crores to grant as a loan to the people, but Here comes the PSL. It means that from the amount of 81 crores, at least 5% will be granted as a PSL. It means that 81 into 5 about 0, 5 is equal to 5, 40 and this. Okay, it means that 4 crores and the 5 lakhs amount will be granted as a loan to the PSL sector. Okay, so after minus 44 crores from this one, we have how much? 77 crores left with us. So from the starting journey of the 100 crores, now only the 77 crores will be left with the bank to grant as a loan at various places. Okay, so this is the condition of the PSL. It means that even after deduction of the CRR and the SLR, still the bank has to grant the some percentage of the remaining result. It means the 5% of the 81 crores to the PSL sector, or this could be larger or smaller. Okay, it means that the RBI decided on the year-to-year basis, on the regular period basis, you can say. Okay, PSL requirements are designed to promote the inclusive growth, support rural development, and ensure that the banking services reach undeserved and the marginalized communities, because these are the communities which are often neglected by the banks because they are not so suitable for their growth. Okay. Hereafter, we have another term known as the Asset Quality Review or AQR. Okay. An asset quality review is an in-depth examination of the bank assessed to assess their credit worthiness and identify any potential risks. Okay. So basically, you can say to check out whether any bank is in the healthy condition or not, we have to check their assets and their liabilities. Okay, how much assets they have, how much liability they have. Okay, and there comes the three conditions basically. First is the healthy condition, second one is the medium condition, and third one is the risky condition. Okay, let's discuss them one by one. First is the healthy condition, when the assets are higher than the liabilities. It's the first condition and it's a healthy condition. Second condition is when the assets are equal to the liabilities. Okay. Third condition is when the assets are lower than the liabilities. Got it? So these are the three conditions we have. All right. On the evaluation of these three conditions, we could say that what is the present condition of the XYZ. Okay. But assets, it is not, you can say, not only possible that the assets which we have seen must be credit worthiness to the bank. Suppose if the assets are low quality assets, it means that those assets which could be decreased by the value over the period of time. Okay, how I can say this? Suppose if the bank has invested in the machinery for the asset, okay, then the machinery is a low quality asset. Why? Because over the period of time, due to the depreciation, the value of the asset will be downgraded. All right. But on the other hand, if the asset is the land, then this will be a high quality asset, because over the period of time, due to the appreciation in the value, the final value of the land will be increased. Okay. So on the basis of that, we had a asset quality review. It means that the bank has to check out their assets on the regular basis, whether the assets are capable to holding the credit worthiness of their significance existence. If it is not, then the bank should be worried. All right. It is typically conducted by our regulatory authorities or the external auditors to ensure that the banks are accurately classifying their assets and maintaining appropriate levels of capital to cover potential losses. All right. So basically, every bank have three kind of audits: internal, second comes the external, and third comes the regulatory. Okay, internal audit is basically being conducted by the bank for their own, you can say, awareness. All right, so that the bank's own management should be aware that what is going inside the bank or what is happening inside the bank. Second is the external. It means that the external auditors have been appointed by the banks. The auditors will come to the bank and then audit the different financial statements of the bank to figure it out what is going to be happen or what is currently happening. All right. Third is the regulatory audit, in which the Reserve Bank of India or the other relevant authorities conduct the bank's audit to figure it out the clear picture. All right. So basically, these audits are specially designed to find out that whether the assets of the banks are good or not. For example, suppose if the bank is showing that we have the assets of rupees 100 crores, okay, in their internal audit, but after the external or the regulatory audit, we have find out if in the year of 2011 the bank having the assets of 100 crores, but the assets were invested in the low quality asset. It means over the period of time, their value will be depreciated. And in the year of 2015, this is the reserved value. It means the value of asset shown in the books of the bank. But due to the over period of time, in the 2015, book value still shows 100 crores. Okay. But after putting the values in the market rate, the assets only worth rupees 60 crores. Okay, it means that this is the value of their purchased. Like in the 2011, when you purchased it or when the bank purchased it, what was the price? According to this, the value has been drawn off. But in the 2015, the same value when it was put to the market rate, then due to the differentiation in the prices of the assets the bank holded in the 2011, the actual value formed out only 60 crores. Okay, it means that the bank's financial health is going to be suffered because the value of their assets are falling rapidly. It means after some period of time, the value of their liabilities exceeding the value of their asset. Okay, and this will be a negative or the bad financial condition, you can say. All right. Second thing is that also the appropriate level of capital is measured. It means that the bank must have the capital reserve to meet the obligations. Suppose in the year of 2015, when we find out that the asset which was showing the value of 100 crores are only worth for the 16 crores right now. It means that the banks must have rupees 40 crores additional to cover it up. Okay, so the 60 plus 40 will be the 100 crores. So we can say the value was covered up. Okay, so these kind of things are basically covered under the asset quality review. Now, what is the actual purpose of the asset quality review? The first is the enhanced transparency and the comparability. Improve the transparency of the bank's asset portfolios and ensure that the assets classification are consistent across the institution. Okay, it means that after doing the asset quality review, we could find it out the transparency. It means the value which was showing as 100 crores was find it out the real value of 60 crores. Okay, so when it could be done only after organizing a proper asset quality review, then only we will come to know that the value only the 60 crores, not the 100 crores. So the transparency is being maintained. Second is identify and assesses the risk. Okay, this comes that topic under types of risk, and we have a detailed discussion over it in the upcoming lectures. Okay, till then you can say identify potential risk associated with the bank's assets such as credit risk, market risk, and the operational risk. All right. Thereafter, assess adequacy of the capital. It means that when the asset quality reviews are being organized, not only the current value of the assets and their worthiness measured, but also the capital adequacy of the bank's measures, that when the situation or the adverse situation will arrive, is the bank is able to meet the obligation or not. As I had provided you answer, 100 CR was the value, 60 CR was the actual value, so that the bank must keep the capital adequacy of 40 CR so that it could be merged with the 60 CR and the original value could be drawn. All right. Thereafter, promote and sound lending practices. Encourage banks to adopt sound lending practices and improve their risk management capabilities. Okay, now we have the scope of an asset quality review. Okay, first is the loan. Assessing the creditworthiness of borrowers and classifying loans based on their risk profile. Okay, suppose if the loan has been granted to the person who having a very good record of paying back the loan on time, it means that this is a safe loan. But if the loan has been granted to a person who having the past record of defaultingness, it means that it will be a risky loan or the bad loan. Okay. Second is the investment. Evaluating the creditworthiness of investment and determining appropriate impairment losses. It means that if the investment has been done in a company like a trading goods and services company, in which the goods value could be vary to the market risk, so it will be a bad investment. But if the investment has been made in a good asset like a purchasing of the land and all, it means that this will be a safe investment. Thereafter, the derivative instruments. Assessing the risk associated with the derivative instruments and ensuring that the banks have adequate hedging strategies in place. Okay, like the other assets, reviewing other assets on the bank's balance sheet such as property, plant and equipment. Okay, now comes the methodology for an asset quality review. Like what is the methods are being adopted in the asset quality review. The methodology for the asset quality review or the AQR typically involves the following steps. The first is a data collection. It means that gathering detailed information on the bank's assets, including loan documentation, credit ratings, and the collateral values. Okay, like all the relevant data should be collected first. Second is the risk assessment. Assessing the creditworthiness of individuals and assets, classify them based on their risk profile. After getting the clear-cut information about the bank by analyzing the loan documentation, credit ratings, and the collateral values, thereafter, the risk assessments begin. It means that classify them as a good risk, bad risk, or worse risk. Okay, this is the types of risk we will be discussed in the upcoming lectures. Thereafter comes the provisioning. It means determining appropriate levels of provisions to cover potential losses arising from impaired asset. Okay, suppose the 100 crores assets were totally evaluated. Out of this, it was found that the 60 crore assets are safe, but the remaining 40 crores are of the volatile nature. Okay, so that how to cover these 40 crores asset is comes under the term of provisioning. All right. Thereafter, capital assessment, evaluating whether banks are holding the sufficient capital to cover the risk associated with their asset. It means that if the 40 crores is the volatile asset, so it means the bank must have a backup to cover this 40 crores in the upcoming future during any adverse situation. All right. Reporting and the follow-up. Preparing reports, summarizing the findings of the AQR and identifying areas for the improvement. This is the last step. Okay. Now, what is the impact of the asset quality review? First is the capital requirements. Banks may be required to increase their capital levels if their assets are deemed to be riskier than the previously assessed. All right. So, in the year of 2011, the 100 crores were the value of the asset showing in the bank's book. Okay. But in the year of 2015, when they assessed again, it was find out only the 60 crores value is safe. All right. And the rupees 40 crores value is either downgraded or bad, or you can say risky. Okay. So now the bank is come to know that they required a 40 crores capital so that they could cover any risk associated with their asset coming in the nearby future. Okay. So the first is the capital requirement. Second is the regulatory actions. Regulatory authorities may take enforcement action against banks found to have engaged in improper lending practices or under provision. Okay, like when the AQR was organized by the regulatory authorities or the external auditors, and it was find out that the bank is claiming that they having the 100 crores assets. Okay, but they had only 60 crores assets after evaluating the value. It means that the authorities may take enforcement action against banks found to have engaged in improper lending practices or under provisioning. It means that they are misrepresenting the information. Okay. Thereafter comes the market perception. Negative findings from an AQR can damage a bank's reputation and make it more difficult to raise capital or attract investors. Okay. Suppose the bank was claiming that they having a reserve for 100 crores. So the investors are feeling safe that if they invest with the bank, then they will have a safe value. But when it was find out that instead of 100 crores, the bank is only having the asset and the reserve of 16 crores. It means the investors who were willing to invest in the bank will keep their hands packed. Why? Because now the not only the value but also the you can say authentication of the bank records has been doubted. Okay, so it may lead to the negative findings or the negative market perception of that particular bank. Okay, what is the importance of asset quality reviews? AQR plays a crucial role in maintaining a financial stability by ensuring that the banks hold a sufficient capital to withstand potential losses and they adopt sound lending practices. All right. Regulatory AQRs help to identify and address potential risks early on, preventing them from escalating into systematic problems. All right. Thereafter, we have the IBC calls insolvency and the bankruptcy code. Okay. About it also we have a detailed lecture incoming. You can say about it also we have a detailed discussion in the upcoming lectures. Okay. First is the insolvency and the bankruptcy code was introduced in the year of 2016 to streamline the process of resolving insolvency and the bankruptcy cases. Okay. It aims to expedite the resolution of distressed asset reduce the burden of non-performing assets on banks, promote on a more efficient and accountable financial point. Right now, you are only required to keep this point in your mind or note it down. When we have a lecture on the IBC, we will discuss these points in details. All right. Thereafter, we have our digital banking initiatives. India has witnessed a significant push towards digital banking and financial inclusion. Okay, as a banking reforms. The first is the Jan Dhan Yojana, which is basically started for no frills or zero balance account. Okay, in the year of 2016. Got it? About no frills or the zero balance account, I had already told you in the previous lectures. Thereafter, we have a Aadhaar enabled payment system. Okay, it means that prior to this, whenever you have to make some payments, you have to submit various documentation, you have to go through various applications and a long procedure. But after introducing the Aadhaar enabled payment system, now only by linking your Aadhaar card with your bank account, you can make the payments. Okay. Thereafter comes the UPI, Unified Payments Interface. Like whenever you use the mobile banking, like Phone Pay, like the Google Pay, Amazon Pay. All right. So basically, you are using the UPI section. Okay. UPI means that the various platforms of the banks are now on this common platform. All right. So that it could make the transaction easy. Okay. So students, basically, these are the developments have shaped the Indian banking sector. Okay. Or you can say by introducing the various reforms over the time, as we have discussed, whatever we have achieved so far is in front of you. First is the financial inclusion. Okay, it means those peoples which could not be reached easily, now they are the part of the Indian banking system. Okay, thereafter modernizing the banking practice. It means that when the competition increases, the bank has to enhance themselves. This lead to the modernization of the banking practice. Third is addressing the critical issues such as bad loans and the insolvency by introducing the IBC 2016. Okay. Fourth is the reflecting ongoing efforts to strengthen the banking system and promote economic growth and stability in India. All right. So these are the steps we have. These are the steps we have achieved so far. All right. So students, basically in this lecture, we had completed the topic of banking reforms. In the next lecture, we will start with the banking mergers. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. All right. With this note, let's end this lecture and thank you.